Good morning and welcome to our session this morning. I'm just going to give this a few moments to allow our attendees to come in from the waiting room into the live session. So please bear with us a second while we allow that to happen. Okay, I can see we've got people joining. Okay. Oh, yes. Okay, I can see we're getting people in from the waiting room. So I think we'll make a start if that's all right with everybody. Yeah. Okay, so the session this morning is on how to successfully sell your business. And we've got two co-presenters today. We've got Nick Rudd from HFMC Wealth and Andrew Watkin from Assynt Corporate Finance. So just before we kind of kick off with the meat of the presentation, I've got a few housekeeping points. You will notice as you join that all of your microphones are muted. So whilst you can hear us, hopefully, we can't hear you. We are recording the session today, and that's so that once we're done here, we can get a link out to you so you can watch the recording back, and there'll be an opportunity to get access to the slides and things that we're using today. So any of the materials that you see today will be available to you after the session. Now, because your lines are muted, we can't take verbal questions from you, but you'll notice on the Zoom control panel just at the bottom, there's a little Q&A function. So if you have questions as we're going through, please ping questions over there. And we are allowing some time at the end so that I can pick those up and ask those verbally of our presenters. So please, as they occur to you or at the end, ping questions in that Q&A function. So to the agenda, I think, Nick, would you like to take the session from here?
I will, thank you. Good morning, everyone. So just as a quick reminder of what we're going to cover. So I'm going first, and we're going to talk about how to establish the amount that you need to be financially independent. And then Andrew's going to cover what part the value of your business plays in that figure, and how to optimize the eventual sale price. And we're both going to cover pitfalls and do's and don'ts and things like that as we go along, and so that should take about 45 minutes, I think, and then we've got time for questions, as Rachel said, at the end. So that's the plan. So by way of very brief introduction to myself and to HFM, you probably won't have heard of HFMC Wealth. We're a independent financial planning practice. We were established in 1986. We've got two offices, one in London, one in Surrey. We've got about 100 staff, and we look after about 1.4 billion of assets for our clients. We're a chartered firm, which only the top 15% of firms have been able to achieve. We've won lots of awards, and if you want to look up more detail about the firm, you can just click on the link when the slides come around. By way of my own background, I'm a chartered financial planner, and I specialise in advising business owners, which I've done for about 25 years. There's a mixture of sectors that my clients come from, and there's a mixture of pre and post transaction. So some of them are sort of very much at the beginning of their journey, and others have come out the other side and are enjoying the fruits of their labours. So again, if you want to know a bit more about me, you can just look me up on LinkedIn, and everything is there. Now, I use a kind of shorthand for what I do. I call what I do working out what's your number. So what do I mean by that? It's really the amount of money that you need to live the lifestyle you want and not run out, effectively. That's what it boils down to. And there are 4 steps into that process. So the first thing we need to start with is mapping out what you need. So what do I mean by that? So obviously living expenses. Not many people are going to want to build up a business, sell it, and then live a worse lifestyle than they do while they're working. So there's that side of things to cover. But your expenses will obviously change over time. So when you've sold your business, you're perhaps going to want to spend time, more hobbies, more travel, those sorts of things. So there's the current and the future expenses. You're going to have probably capital items. So maybe it's a holiday property, maybe it's helping the kids onto the property ladder, paying off mortgages. So there'll be various sort of capex items that you'd think about as well. We need to think about things like inflation. What impact will that have? And actually, what if there's something unforeseen happens? The proverbial number 9 bus, or someone in the family is long-term sick. So those sorts of things need to be mapped out as the starting point. Then we map out what you've got. So obviously that's assets, and the business value will play a part in that, but it's also current and future income. The next stage is then to look at how closely aligned those things are. So how do you know that your asset base is going to last? And it's quite possible, depending on how far away the sale is going to be, that you're not exactly sure what the sale price is going to be. So working out how much is enough is obviously crucial. So to give you an example, if let's say you think your business is worth £2 million, if somebody offered you 1.5, would you take that? Well, put like that, probably not actually. But what if you knew that £1.5 million was enough to do everything that you wanted to do with your life? Well, in that situation, maybe you would. You certainly, I think, perhaps think about it. So this is really about putting that vital information in your hands as early as possible. And then the final step is going through those first 3 steps, the planning, the steps that you need to take to optimize your situation. It sort of naturally flows from that. So that's really the process we go through. So I thought I would sort of try and show you an example to make that live a little. So I'm just going to move from the slides into something else. I'll just stop that share there and just go into a different screen. So hopefully you can see a different background now. This is what we call Money Map, and it's a piece of software that basically takes us through the steps I've just described. So this is a fictitious client, John and Rebecca, and their children, Daisy and Joe. And we start by building a timeline where we've got John's age along the bottom here, all the way to age 100. And these icons are basically financial events that we're going to build into the modeling process that we go through. So we've obviously got retirement, we've got the business sale, we've got university costs for Daisy and Joseph. Now, John and Rebecca want to buy a holiday home when they've retired and sold their business, so that's in here. And then we've got some property deposits for the kids. Now, in reality, these are usually a lot more complicated than this, but this is just to sort of give you a flavour. We can build as many different events as the situation dictates. So once we've done that first step, the next thing we do is put in your assets. So savings, investments, pensions, property, that sort of thing. So I won't show you every screen, but just to give you an example. So this is John's pension, and he's got a SIT with £500,000, which is here, and then the company is paying 10% of his salary as contributions. So we put all of the assets in. The next thing we do is put the liabilities in. Now that usually means mortgage, not always, but usually. So in the mortgage section, so we've got a £250,000 mortgage here, 3% interest rate. It's going to take 10 years to pay it off. It's a repayment mortgage. And what you can see down here is just the level of the mortgage decreasing over time. So it disappears just before they reach retirement. Then we've got income to put in, obviously. So salary, dividends, future pension income, state pension, that kind of thing. So again, just to show you one example, got John's income from the business. So he's got his salary and his bonus here. So that's basically the income stuff. And then actually last and most definitely not least, because it's the fun bit, the expenses. So we've got obviously boring sort of basic living expenses. So John and Rebecca think it's going to cost them about £4,000 a month to, to pay the bills. And at the moment, what I've got in here is then university costs for the kids. And I've also got the property deposits for the kids in sort of a bit later. Now, you'd probably also have things in here like extra holidays or, you name it. There's a gazillion different things that we could put in here. But also don't forget, I told you about that cottage. It's a capital expenditure item. So we've got the cottage here, £300,000 they're going to spend on this cottage. And you'll see down here that event takes place at retirement. That's where they purchase that property. So, there's all sorts of things that we would put into the expenses, sort of present and future. Those are just a few examples. Other ones might be, long-term care, if you think you might need that, or charitable donations, those sorts of things. So once we put all of that in, we then get to the modeling stage. And so let me explain what you're looking at here. So this is in effect just a recreation of the timeline that we started with. So we've got the ages along the bottom, still to age 100. The little yellow dots are the financial events that we talked about. And if I just actually take those out, it's probably easier to do it this way. So the black line is basically what we've told the program this person needs to spend in each year. So it effectively knows what money it's got to find, and red is bad. Basically, red is a shortfall. There isn't the liquid assets to cover that expenditure. So what the program does is says, right, so where am I going to get that money from to pay those expenses? So when we start putting things back in, employment, pensions, savings and investments, etc., it starts to fill in the gaps. So as you can see, we're fine, actually, all the way up to retirement, got no problems, but we run out of liquid assets in our mid-60s as it currently stands. We've got a shortfall here. Now, don't forget, the business sale is not in here yet because it hasn't happened, and we don't necessarily know what the sale price or the net proceeds of the business sale is going to be. So let's hypothesize that the net proceeds are going to be 1.5 million. We can effectively create a what-if scenario that incorporates the proceeds from the business. And as you can see, quite a lot of that red has disappeared. We can just do a side-by-side comparison here. So this is what we were looking at, where the shortfall starts in the mid-60s. We've now got all the way out to about 80. So that's not 80, I beg your pardon, mid-80s. So that's an improvement. What if the business was worth sort of net 2 million? Takes us out further still. So again, doing a comparison, you can see that it makes a substantial difference. But remember, we might not know what the net proceeds are going to be. So, this, I think, needs to be a relatively conservative exercise. It's no good doing something where everything has to work perfectly for your plan to stack up. So what else could we do? Well, what we could do is go back to 1.5 million, but we incorporate a downsize of their property in their 80s, let's say. It could be anywhere, but I've picked 80. So again, if we just do a comparison side by side, just make that a little bit bigger, then you can see there's no shortfall here at all. So what the software enables us to do is to look at these different what if scenarios and compare them. And in reality, I've just shown you some very simple stuff that you can see easily, sort of the differences it makes. But in reality, there's a lot more we could do. So we've got 12 years until the business is going to be sold. So we would incorporate modeling the company putting extra saving into John's pension and potentially Rebecca's as well. What happens if we utilize their ISAs? What happens if we make better use of their tax allowances? So all of those different tweaks that we can make, we can model those side by side, and effectively the different scenarios, you can compare them. The software allows for the tax along the way. It works out the capital gains tax, the income tax, etc. It allows for inflation. It knows to apply different growth rates to money in the bank, to money that's invested. And so you can compare the status quo with these different what if points, and the planning sort of naturally flows from that. So you can kind of see in real time, based on the assumptions, what impact it would have. So that's basically the process we go through. To make it live a little bit more, what sort of what ifs should you perhaps be thinking about? So I always think a more lavish retirement is a good place to start. You've worked all your life, so I always encourage clients to really think what's important to them, and be, go big as far as that's concerned. You might want to help the kids. You might want to help a charity, set up a charitable trust. You need to think about things like long-term care. Where would the money come from if that were needed? And assuming you don't want to use the property value. You do need to think about things like what if something happens to one of you, if the proverbial number 9 bus knocks you down crossing the road, or there's a serious illness, what financial impact would that have? Market crash, the impact of market crash on your investments, we can model that. Different sale values at different times. So there's a lot of different things that we can incorporate into the sort of final plan, but certainly looking at it in advance really helps inform the planning. So that hopefully gives you a flavour. I'm going to just stop that and go back to my slides. And just move it on a stage. So to sum up the benefits of the money map exercise, I think what it really does is it asks the question, are your goals and aspirations realistic, and are you on track? It enables you to have an objective assessment of the situation. Obviously, your number if you've gone through this process. As I said, it enables you to map out these multiple different scenarios and compare them side by side. And you've effectively then got a roadmap to follow, and the planning that we talked about naturally flows from this. But one sort of minor word of warning, it's obviously only as good as the assumptions used. So it does make sense to keep that under review, because taxes change, the value of your business might change, etc., etc. So it does make sense to keep it under review. But hopefully that gives you a flavour of how it works and how important it is to work out your number. And I'm now going to hand over to Andrew, who's going to talk about the part that your business plays in that exercise. There we go. Over to you, Andrew.
Nick, thank you very much. That model I found very useful, because as some of you know, a few years ago, I used to run Baker Watkin, an accountancy practice based in Stevenage. And I decided that at the age of 50, I wanted to get out by the time that I was 60. And the third person I spoke to say this is what I wanted to do was, at the time, my wealth advisor. And I said, how much do I need in my pension fund in order to have a retirement income of such and such? So I achieved what I wanted to do, in fact, by the age of 59. But the thought processes behind the business itself didn't change in terms of the employees and the clients. But what did change was I realized that the business had to be there and functioning without me. So my name is Andrew Watkin. The name of my business is Assynt Corporate Finance. And I suppose you may well ask, well, why am I still doing it? Well, it's the joy of learning. It's the joy of learning how a business works and how it makes money. And I think that the money map model that Nick has just demonstrated to us can give you a lot more confidence in the decision to move on to the next stage of your life, especially running the different scenarios. Nick, could I have the next slide, please? It really is a big step moving on to the next stage in your life. And in some respects, it's a leap of faith. But with a model that Nick has just demonstrated, the although the mountain is climbed in several steps, the model itself and using that model is part of those steps. And that will then help you to create a plan as to how you can then move on to that next stage. Nick, could you, next slide, please. So why should you plan for the next phase of your life? Well, in a recent poll of advisors who look after selling businesses, they were asked the following question. In your experience, do owners plan for the next phase of their lives? Select one of the following. There were three choices here: too early, too late, or just about right. It won't surprise you to know that most advisors said that the answer was too late. Nick, next slide, please. So why is the outcome, what is the outcome of being too late? Well, you could leave money on the table because the business has peaked. There could be unforced errors, such as not holding enough shares for too short a period of time. There's also situations where you need to be able to demonstrate to a buyer the underlying profitability of a business. And whilst there's no harm in having a lifestyle business where members of the family take money out, it's important that that is cleaned up so that the underlying profitability and cash generation of the business can be demonstrated to a buyer. Last but not least, and I've seen this happen, you can be lured into a deal by a sole buyer who seduces you into a price, merely to chop it down later because they know that you will become worn out by the whole thing. Next, please, Nick. So, having looked at Nick's model, and you know, or you have a pretty good idea of the number that you require for your retirement fund, then we can determine the road to go down. And essentially, I think there are two choices. And that's either to build value into the business if there's a shortfall, or if there's enough in the fund, then we harvest the value that's there in the business. Next, please, Nick. Let's take Nick's example of a business, say, being worth 2 million. If your other investments are worth, let's say, £1 million, then 2/3 of your wealth is tied up in your business. And we've seen over the last 20 years that it's quite regular for catastrophes to happen. We've had 9/11, we've had the 2008 crash, we've had COVID, we've had Brexit, and goodness knows what's around the corner. So if a lot of your wealth is tied up in your business, it is, I think, at high risk. And it's all very well us saying, oh, well, we think the business is worth this. But until some buyers come along and make an offer for you, you really don't know what it's going to be worth in the real world. Next, please, Nick. It's important, though, that for the clients that I'm acting for who are and who have decided to sell their business, that I build trust with them. I'm in a privileged position because you will be trusting me with quite a lot of money. And it's fundamental to me that you receive the best deal in the circumstances. I try and be as, I think we're back on. I try and be as open as possible about fees for each part of both the marketing process of the business and the actual sale process. But at the end of the day, I have to be honest with my clients. And at the moment, for example, I have one client that is loss-making and they have decided to sell their business. And really, we've got to sit down and say, is this the right time? Should you now sit back and regenerate the business so it can make profits? Or do we go to the market and see what the reaction is going to be? Next slide, please, Nick. So I think it comes down to a three-part approach. If you've decided and you've got through the emotional bit and you're ready to move on to the next stage, then I think that you need to be able to look in the mirror and ask yourself, why am I selling my business? Because what I will do, if everything goes according to plan, have one or two people that are interested in buying your business. And I will need to put you in front of those people and they will ask the question, Peter, why are you selling the business? And I think what you need to do is to rehearse what you say and be genuine in the way you say it. So it's okay to say things like, I want to diversify my wealth, or I want to cash in, or I want to have a new business that I'm ready to start, or I want to be involved in philanthropic things. If you say things like, well, I'm burned out, I've got family problems, I've got health problems, I'm stressed, I don't have enough time, that's not going to look really good in the eyes of a buyer. And so therefore, you really need to be absolutely sure that the idea to sell the business is something that you've made your mind up to do, and that there is a clear plan for the business in the future in order that we can get the best deal. The second part is then speaking to someone like Nick and finding out what your freedom point is, so that we know what to do, so we can work towards the end game, which is either that you build some value into the company or you harvest what is there. Next, please, Nick. Once you've decided to sell, there are in effect really only three routes. You can pass on to the family members, which may or may not involve a capital sum, or you can sell for that capital sum. Now here, there are some options in terms of we could sell it to another company, a competitor, or someone that wants to move into your marketplace. We could consider something like an employee ownership trust, such as Julian Richter did with Richard Sounds. We can have a management buyout where the senior employees take on the business and provide the owner with a capital sum, and that can include family members, of course. Or there can be a management buy-in where someone comes in with money and then takes the business forward. The worst case scenario, I think, is normally speaking to wind up the business, but that really is your default position, particularly at the moment with the stresses and strains of COVID. Next slide, please, Nick. Talking about value is entirely academic until you attract an offer, and your readiness to move on to the next stage of your life in the process where I'm marketing the business is really important. And one of the first questions that the buyer asks is, how many hours does the owner work in the business? Next slide, please, Nick. So I think the readiness to move on is really important. And as I say, business valuation is not an exact science, even if I do it myself as a desk valuation. But what is not overlooked by the buyers, as I've said, is the owner's intentions and the reasons for exit, and the steps that you are going to take as the seller to prepare that business for sale. Because the more ready it is, the more attractive it will be to buyers, and the more likelihood is that you will get an offer. And these things really do play a significant part in attracting that offer. But it all starts very much with something called the owner's trap. Next slide, please, Nick. This is something that I come across quite frequently, because the owner likes doing sales. He or she is comfortable doing those sales, and they end up offering too many products or services to different clients or customers. And in another example I have, where there is quite a range of products, the sellers really don't know what the margins are on each of those products, which is not a good start. The owner believes that they're the only person capable of delivering that service, and as such has built up good relationships with the customers. Now that's all well and good, but if you've made up your mind to sell the business and harvest what's there, then it's no good that intellectual property, if you like, or the goodwill being included with you. It's got to be in the senior people and the employees themselves, so that you are separate from the business. Otherwise, the offers coming in are not going to be the best that they can be. Next slide, please, Nick. You can Google, I think, what makes a business sellable. But recently I've been involved in selling business, and some of the questions that are coming up from buyers are growth. Is the growth profitable, and is it generating cash? Because a lot of the future is in that growth, and that's what the buyers want to see. So the ability to project your turnover, and I appreciate that is really difficult at the moment, but if you have a CIM system, a customer relationship management system that can demonstrate how you can gather sales and the average value of sales and what you have to do to achieve that, that's really helpful. If you have recurring income that comes in regularly, either on a monthly or an annual basis, that also helps. But being able to predict that turnover is quite important. And it's something that I prime clients to do, because what I don't want is for them to predict turnover at a very early stage in negotiations, for them to say later on during the process, which can take 6 to 9 months at the very least, that the turnover has actually dropped. So it's being confident in that turnover, projected turnover figure is really crucial if you want to get the best deal. A business plan helps because it is able you to set out to the owner how you see the business developing. Now, that's not a 20-page plan with reams of Excel spreadsheets of balance sheets and profit and loss accounts. In my view, it's a simple 1 or 2 page plan. Where is the business now? Where does it need to be in the future? How are you going to get there? What are the actions needed? And who does what and when? And how do they do it? That's the plan. That's the detail. It doesn't need pages and pages. A couple of pages is more than enough. Other subsidiary things is, when do customers pay? Do you have outstanding debts? Do you have a bad debt record? Is a large percentage of turnover with one customer? Normally it's 10%. If 10% or more is with one customer, that's not particularly good. Now, in some cases, you can't do anything about it, but at least you're aware of the situation before you go into the marketing of the business. How often do customers need to buy from you? That's about the recurring income. And if you can create recurring income, that's going to help get the best deal. And how long have employees been with you? Now, buyers will look at employees, and it's daft if they then get rid of everyone. They will want, in my experience, to keep on those employees that are really adding value into the business. Unfortunately, those that aren't, they may well decide to leave. But if there's a stable workforce with some good employees in there, then that's really helpful for the future, getting the best possible deal. Nick, the next slide. Whoops, we've jumped.
1, 2, sorry. There we go. Beg your pardon.
That's it. Nick's hinted about taxation, and I'm not going to go on about it, but generally the sale of shares in a company is a capital gain and taxed under the capital gains tax rules. Currently, there's something called business asset disposal relief, which was entrepreneurs relief, such that the gain of up to 1 million after costs and your annual exemption is taxed at 10%. Now, that's the simple bit, since you have to hold shares for a certain period of time, and you have to hold at least 5% of the shares in order to get this relief. Now, that's the simple bit, but it may well change in the next budget. But to give you just an idea, we've been talking up to now about, let's say, a £2 million net proceeds when you sell your business. If we assume that the cost of selling it are 120,000 and that you do have your annual exemption of 12,300, then the gross proceeds are going to be something in the region of 2.5 million. And that's because that first million is only taxed at 10%, whereas the next band is taxed at the high rate of 20%. Hopefully this won't change in the budget, which is due shortly, but we'll have to wait and see. Next slide, please. I wanted just to show you an example where it all went wrong, and it took me 3 attempts to persuade my client not to proceed. There were two, a brother and a sister. The brother had the funds and the sister was an employee in the company. And the owner came down one morning looking really frustrated and said to the sister, "I want to sell my business. Do you want to buy it?" Well, the sister had to think about it and spoke to her brother, and they decided, yes, that would be a good idea. And they appointed me to help them do this. Well, we started to ask some questions. We asked about IR35 because it was a coach operator. And what we found was that there were very few employees and a lot of subcontractors. And we said, well, are these subcontractors in fact subcontractors rather than employees? And the owner came back and said, I have a report from my accountant that says they are subcontractors. We said, fine, we'll take an indemnity then on the sale proceeds, just in case that all goes wrong. Well, that upset the client, but the seller, but we had no recourse to the accountants. We then started to look at the sales contracts and found that there was something called a change of control clause in there. Obviously, they had the contracts with the local authorities, but if my client, the brother and sister, ended up owning the shares, that was deemed to be change of control and gave the councils the right to renegotiate contracts, which obviously added another layer of risk. The owner of the business owned the site on which the coaches were based, and there was quite a long driveway to get to the warehouses and where the coaches were kept. And as we started asking more and more questions, he started to hint that he was going to put gates on and stop us doing this and stop us doing that. Now, even with a lease, that might have been just too much. And then finally, there wasn't really a management structure there. The sister would have to come in on day one and be working, in the words of Michael Gerber, working on the business and not in it, because she would need to borrow funds in order to buy the shares. She would need to generate more profits in order to repay that and to pay herself a reasonable salary for the extra responsibility and stress she was under. Anyway, it took 3 attempts for me to tell the client, guys, stop it, walk away. This isn't going to work. Whether that company's been sold, I don't know, but there were just some examples of where it can all go wrong, and when the owner woke up one morning and had enough and went down and hadn't appreciated what the sale process was going to be like. Next slide, please, Nick. So to sum up, I hope I've addressed these issues, that you now have a better appreciation of the risks of doing nothing and leaving it too late to move on to the next stage of your life. You can understand some of the pitfalls, and although I've dealt with them on a very high level, you can obviously, I hope, that these would be relevant to yourself. A better understanding of the key aspects to increase the chances of receiving an offer, and when is the best time to sell. In my view, the best time to sell is when you've reached your number, i.e. your freedom point, because then you're in a situation where you can decide how you're going to do it. And finally, and not least, the impact of tax on those gross sale proceeds, which will give you the funds you want to enjoy the next chapter of your life. Next slide, please, Nick. These are my contact details, and there's obviously a LinkedIn page that you can have a look at. Rachel, I believe there might be some questions.
Yes, I've got a few that have come in. If anyone else would like to ping over a question, please use the Q&A function at the bottom of the screen or the chat. Either of those is fine. We can pick them up and I will read them out to our presenters. The first one I think is for you, Andrew. How would you say that COVID has affected business sales?
Certainly the volumes went up towards the ends of last year, and for the first quarter of this year, they've begun to drop. Certain industries have been affected in different ways. For example, business services, they have gone up, whereas retail trade, for obvious reasons, hospitality and tourism, the number of transactions has gone down in that. From a specific business point of view, if you've had a profitable and cash generative business pre-COVID, and you're in a position to be able to demonstrate that with a decent runway ahead of you, that that is going to return, or may have even returned as we speak, then there's a much better chance that you're going to get an offer for your business. But if the business has really suffered and you've ended up taking on the Sybil's loan or the bounce back loans, you've also taken on furlough, you've deferred VAT, then I really do think that you need to sit back and say, have I got enough time in my working life? And am I prepared to rebuild the company to get it back to generating profits and cash? I think at the moment it really is the business generating profits and cash? And can a buyer see that either happening now as a result of coming out of COVID and you're back on track, or that it's likely to happen in, let's say, 6 months' time, in which case, if you have reached your freedom point, maybe we should just delay that sale process or starting that marketing process until you've got into a situation where you can clearly demonstrate that, let's say, for the last 6 or 9 months, the business has been profitable and has been generating cash.
Okay, thank you. I'm not sure who this question is for. You can decide. But how do you work out the tax? Now, Andrew, you talked a little bit about that, but are you able to talk about that a bit more? Or Nick, is that one for you?
Andrew, do you want me to take that?
Please, Nick.
Okay, so assuming it's about the software, then basically the answer is that it's pre-programmed with the various different income tax thresholds. And because I have to sort of quite accurately input what's salary, what's dividend, what's interest from a bank account, what's capital gain, the system then knows the difference and it can effectively work the tax out year on year. So it has to assume that the tax rates that apply in the current tax year will continue to apply, but it will inflation link the thresholds. So it's basically a fairly accurate calculation, but it does assume that today's tax system applies in the future.
Okay, and this is a question for you, Nick, about that money map that you showed. When is the best time to do that? I guess in one's life, I'm imagining, not the time of year.
So in truth, I think the answer is as early as you possibly can, because I made the point about trying to put the information in your hands as early as possible. So the sooner you do it, the better. So I'll give you an example. I did a project for a client about 6 months ago, where we were doing all the things that we've talked about today. And the way that he'd constructed his salary and the dividend that he paid himself, and the amount that went into pension, the pension scheme, was such that he'd actually reduced, basically, sorry, it's a little bit technical. If your earnings go above a certain level, the amount that you or a company can put into your pension scheme is curtailed. So it meant that he was paying all this income tax on his salary and his dividends, and by changing it so that the company put more into his pension, he reduced his salary a little bit and changed the mix with dividends. And it effectively meant that the company could shelter far more of its profits over the sort of 5 years that he'd anticipated between when he started and when he'd sell his business. There was far more profit that could be sheltered in the pension scheme and he therefore not pay tax on, than if he left the system the way it was. So we're kind of able to give him a before and after. And he's got 5 years then to make use of those differences. So ideally, the earlier the better, but I do recognise that in reality, sometimes it can be, the year before.
Yeah. Andrew, you talked about it being important not to be part of the business. How does a business owner get out? What are your tips?
The simple tip, and one of the ones I used, and I know other clients have, is literally to tell staff, I'm going to play golf this afternoon. I'll be back in the morning. Let me know if there's any problems. No, seriously, I think you can't drop people in at the deep end, but I think you have to have the ability to convince yourself that your staff can get on with it. And the only way to do that is to trust them to do that. Now, I'm talking very generic now, but in terms of if you've got a number two, you would hope that that number two could get on with it without you being there, because that's the whole point of having a number two. But if, say, you've got someone that does frequently come back to you, asking you questions that you really feel that they should know the answers to, then I think it is a matter of sitting them down and saying, look, John, I've paid you to do all of this. You've got to take the initiative. You know, providing you don't make a total cock up, I'm not going to give you a bollocking, excuse my French. But I think you have to actually lead the business, because if you're not there, notwithstanding mobile connection and all of that, they have to deal with the problems as they arise because you're not there. Now, providing you've got reasonable confidence in them, they're not going to do it as well as you. We all know that. But unless you test the water, you're just not going to know. And you can increase those absences and probably increase the amount of time or notice that you give them. So the first time you might say you give them a day's notice. The next time you might give 2 days notice and it's going to be a whole day. The next time it might be 3 days notice and it's going to be 3 or 4 days. Good example I had in the practice was that I realized that I had to show people how to do things, and particularly in the management of the practice. And one thing I started to do was to show someone how to do it. A young lady who joined us. That took quite a bit of time. Second time, it took much less time. The third time, she was doing it much better than I could have done it. So sometimes the staff actually can do it better than you.
Okay, I've just put out a final call for questions. I don't think I've got any more that have come through. I'll just check there's none on the chat. No. Okay, in which case, I'm going to say thank you very much to everybody who attended. We will get an email out to you later today that has an opportunity to link to the recording and to get access to the slides that we used. If there's anything else that you would like to know in the meantime, the contact details of the presenters are there, but you'll also have my details, and I can obviously pass your messages on to either Andrew or to Nick. Thank you very much to Nick and to Andrew for your presentation today, and hopefully we will be in touch with some of you soon. Thank you.
Cheerio.